really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out.
So that's Jerome Powell. He's in charge of the Federal Reserve and they control everything that's going on in the economy right now. They just had a super important meeting where he said some really good things and some really bad things. And all investors are wondering right now, are we going to go into recession? Is the stock market going to keep going down? Are we going to rebound and go higher from right here? So let's break it down in a no BS way. Don't subscribe, don't go buy anything. Just watch the video and learn from it because we're all here for one reason, to make money.
Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years.
So yeah, the stock market's taking a dip right now. Of course, people aren't going to be confident in the economy right now. A lot of people are wondering, am I going to get fired? Am I going to get laid off? If I do get laid off, can I find another job? There's a lot of things going on out there right now, especially with tariffs and interest rates. I mean, I could keep going on and on and on about this stuff, but what I'm going to say right now is this. The market peaked out February 19th at roughly $540 per share for Triple Q, which tracks the NASDAQ. Now it's at $480 per share. So every single investor out there, we're all here to make money. Do we buy this dip or are we going to keep going lower? Maybe you're going to catch a falling knife if you buy it right now. So Jerome Powell is basically saying there is a lot of uncertainty out there right now, and that's being reflected in all these surveys that are happening right now too. I mean, just look at the fear-greed index right now. We are in the extreme fear category over here at a 22, which is actually really, really crazy right now because the stock market did recently do a little bit of a pop back, but of course, we're still way down from the all-time highs. So everybody right now is bearish. Everybody is freaking out. They're selling. They're calling their friends and saying, oh my God, I'm losing so much money in the stock market. But me, I'm cool, I'm calm, I'm collected. I am not over leveraged right now because I knew that the stock market was a little bit overvalued even before all this tariff stuff started happening. So when you understand that stuff, it doesn't really matter what the stock market's going to do. But of course, the purpose of this video is to break down, is the market actually going to keep going down? Is it going to rebound and go higher? What should we do right now to capitalize, which we're going to get into that in just a second. But we really have to break down what the Fed just said because he's a very smart guy with a lot of information that we don't have access to. So we have to see what he has to say to know what we should do to capitalize on.
But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs. So you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months.
So two super important charts that really break down what Jerome Powell was just saying. So the first one is going to show you the unemployment rate, and the second one is going to show you the job openings by industry. So if we start over here on the first chart, it's honestly very interesting. So you can see all the way back here in 2005, the unemployment rate was roughly 5.2%. Then it was starting to trend down pretty good right before the 2008 market crash. The market crash and unemployment went way up. This was the housing market crash that happened right here. And we went up to roughly 10% on the unemployment rate. Now we've seen an unemployment rate drop all the way from 10% all the way to roughly 3.5% pre-COVID. COVID happened, that went way up to 14.8%, and then it came down. So we did hit this bottom right here in April of 2023 of 3.4%. But look at the trend that's happening right now. We went from 3.4% and we're trending up slowly to 4.1% right now. And keep in mind, this is all during tariff uncertainty, Doge laying a bunch of people off, interest rates potentially going higher, labor market potentially weakening, and potentially going into a recession. All of this is happening in that time period right here. And look at the similarities between right now and when we actually had recessions. So right here, unemployment was trending down pretty good, and then unemployment started to tick up, and then bam, it just goes straight up and we're in a full-blown recession, which was 2008 right here. And keep in mind, the stock market went down roughly 50% in this time period right here. And then unemployment starts to tick down. The economy starts to come back a little bit. And then bam, unemployment goes straight up again. And of course, this was COVID, but just look at how quick unemployment comes when it does come. And then look at this time period right here. Unemployment's pretty low right now, and then it's starting to tick up. All of the time that there's a lot of uncertainty in the market, and honestly, a lot of that stuff could come true. And then bam, maybe we're gonna have unemployment go straight up and we go into a full-blown recession. Now, the thing that makes things a little bit worse is this chart right here. So this is basically showing you how many job openings there were by sector. And you can see the trend from 2010 to roughly 2023. There's a lot of hiring that's going on in this time period right here. But if you go from 2023 to current, which I won't move my cursor on it because it's kind of annoying, you can see we're trending down right there. So basically, what's going on there is CEOs are less optimistic to go hire new employees at their business because maybe they're going to have to lay people off. Maybe there's going to be less demand in the economy. And when you understand that the United States economy is a massive consumer based economy, you'll understand that if people spend less money and people have less money, they're probably going to have less money if they don't have jobs. They're just going to buy less stuff and the economy is going to go down the tubes, and a lot of these companies in the S&P 500 are going to go down with it. So what happens is if there's not a lot of liquidity, and this is kind of how the stock market works too, if there's low liquidity but a lot of demand for something, the stock price is going to go way up. So just think of this as a stock chart right here. If there's a lot of demand to be unemployed and there's not a lot of, jobs out there to fill these unemployed positions, this is going to go way up. And what happens is when this goes way up, all the CEOs, all the businesses are going to be way less confident about the economy because there's a ton of people that don't have a job. And there's all these people, there's thousands, tens of thousands of people that are getting laid off at Doge right now that are not being reflected in this data yet. So it's very, very likely that as the months come by, this data is going to get a lot worse. I think that unemployment is definitely going to trend up because there's not that many jobs to go replace all these people that are getting laid off from Doge. I mean, are you really going to go buy a new car from Tesla or buy a new phone from Apple or buy a new computer from Microsoft? Are you going to go do any of that stuff if you don't have money? Obviously not. So if the economy goes into a recession and you start getting laid off and people don't have money, that's going to hurt the stock market quite a bit. And people are going to wish that they sold at levels right now. Now, in just a second, I'm going to go into the bullish side of everything so you really understand both sides of the story.
Let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
So now to the bullish side of the argument, Jerome Powell is saying right now overall things look okay, but a lot of people are worried about the potential downside risk. And remember, the stock market, even though it fell roughly 10%, in my opinion, it is still a little bit overvalued based on the chart right here. So the lighter line right here corresponds to the S&P 500, and the darker line corresponds to the earnings growth of the S&P 500. So this is the earnings per share. In the long run, earnings per share in the actual S&P 500, they typically move up the same on a percentage basis. And you can see right here, the market was clearly undervalued because the market fell more and way below what the actual earnings of the S&P 500 did. And then a time period right now, you could see the market got very disconnected from what the actual earnings were doing. This is the earnings right here, and this is the market right here. But now that we got this little correction down right here, things are priced a lot more appropriately than when they were way up here. So understand that even if the market stays flat, the market is still getting cheaper in the long run because earnings are still growing. So eventually this line is going to keep going up, and then it's going to intersect with the actual stock chart right here. Now, I know it seems very, very basic to just look at a chart and say the earnings growth is this and the actual market did this, so the company or the ETF is valued appropriately or not. It's not a one-size-fits-all thing, but it is a very good way to look at and understand that The market's a little bit expensive right here, it's a little bit cheap right here, and it's honestly not a coincidence that Warren Buffett has so much cash right now and he didn't buy back any Berkshire Hathaway stock in 2024. Warren's number one rule to buy back a stock is that it has to be trading near or below intrinsic value. So the fact that he bought no Berkshire Hathaway stock back in 2024 and he has so much money in cash, he's basically saying as clear as he possibly could that the market is a little bit expensive and he's not buying at these price levels right now. So what I'm personally doing right now is I'm being very careful when I make new trades in the market, but understand that there is still a lot of opportunity in the market right now. Some companies fell way below intrinsic value that I'm buying calls and selling puts on, for example, and making a lot of money doing it, but also understanding that all boats usually rise and fall with the tide. If the market goes down, meaning the S&P 500 and or the NASDAQ, a lot of the companies that I'm making trades on are obviously in the NASDAQ and the S&P 500. So even if those individual companies are undervalued, they're probably going to get dragged down with the overall market. So understand that maybe a company is undervalued, but if the overall market is still overvalued, everything could fall together. So how low can we go? Well, this was roughly a 10% drop right here, and we're still above the growth line quite a bit. And of course, you could just go to the left right here and say, it's roughly 5,100 for the S&P 500. But understand that just because we hit the earnings growth line, that doesn't mean that we're at fair value. Right here, you can see we're quite a bit below what the earnings growth actually is. So maybe the market falls all the way down to here, which kind of corresponds to a 20% price drop. So understand that you don't want to catch a falling knife. We could go lower, but we could go higher from here. And if we go higher, we're definitely going to need to see earnings growth grow by quite a bit, or the market valuation is not going to be justified. Also understand that interest rates are gravity on the stock market. If interest rates continue to trend down, that's good for the stock market, and it could continue to trend higher because more people are going to want to go buy things out there in the economy, and it's going to make more profits for these companies. So that's what I got for you guys today. Click the link below if you want to get into my academy. It's going to teach you everything I know about investing, stocks and options, all the good stuff. But if you don't want to do the academy, I really recommend you watch this video right here. It's the 7 key things that I learned that I wish I knew earlier that will make anybody a millionaire in 2025. I'll see you guys there.